Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglikar. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
In the run-up to the upcoming union budget, finance ministers of some states, mostly ruled by opposition parties, have demanded a 10 percentage point jump in their share of revenue from GST collections. From the current 50%, they want it to be increased to 60%. So what is behind this demand? And what will be its impact if implemented? Debar Gasanyal answers these questions.
The countdown to Union Budget 2023 has started. Union Finance Minister Nirmala Sitharaman and her team are holding meetings to take views and listen to the demands of all the stakeholders. In one such meeting with state finance ministers, Sitharaman was given a list of demands. Some of them were difficult ones. A few states, mostly ruled by opposition parties, demanded greater fiscal autonomy through an increase in states' share in goods and services tax to 60% from 50% at present, and an extension of the GST compensation period by another 5 years. States like Kerala, West Bengal, Chhattisgarh, and Tamil Nadu, among others, argued that cesses and surcharges as a percentage of gross tax revenue has increased from 10.4% in 2011-2012 to 26.7% in 2021-2022. Tamil Nadu Finance Minister P. Thiagarajan claimed that this has deprived states of their legitimate share of revenue collected by the union government. Citing 15th Finance Commission report, Kerala Finance Minister K. N. Balagopal pointed out that 62.7% of total receipts are being taken by the union government, while 62.4% of the expenditure commitments are on the shoulders of the state governments.
The logic really, if you stretch it, is the fact that when GST subsumed all the sales tax, states lost almost up to 2/3 of their revenue sources on which they had control. In terms of fiscal autonomy or reduction of fiscal autonomy, as it were, what had happened was that states gave up almost 58% of their total powers, whereas center gave about 42%. In line with the correction in that if I have given up 58%, I must get 58% share. That seems to be the underlying logic of asking for 60%. It doesn't come out of thin air. It comes out from the fact that what is the sacrifice that is entailed by states collectively as the subnational governments.
Chief Policy Advisor at EY India, D.K. Srivastava, agrees.
They do not have much control on the GST rates, and they cannot increase the tax revenues by working on the tax rates, because that will have to be carried through the GST Council, where they do not have much control individually or even jointly, because most of the GST Council deliberations are controlled by the central government.
Drabu, however, is quick to point out that the particulars of the current GST regime may prevent the states from accepting such a demand.
Currently, the state to center share is 50-50. Now, while states are seeking to increase it to 60%, the fact remains that from the existing system of 50% that the center gets, 42% of that is devolved to the states based on the Finance Commission recommendations. So it's not effectively a share of 50-50. It is actually more than that. And if you were to take it to 60%, then 42% of 60% means another 26%. So you're really talking about, almost 80% revenues going to states. Also, one has to be cognizant of the fact that with that kind of revenue shares, how will the center be able to finance its own expenditures and also the compensation for the states?
Former Finance Minister of Kerala, T.M. Thomas Isaac, however, believes that the GST regime requires fundamental changes.
See, unfortunately, this I don't think the central government takes federalism very seriously. And therefore, under the slogan of one tax, one nation, one tax, it goes against that principle to have some differential rates, a small amount, say 0.5%, 1% for this GST. A state which wants to spend more and has to mobilize more resources. For example, a state like Kerala, we spend on education, healthcare, and so on. And we would like to have more revenue. And the state people are willing to give that revenue. Why do you want to prevent that?
While experts believe it's quite unlikely for the centre to agree with the state's demands to expand their GST share, it is also clear that the issue is quickly gaining traction across states and is likely to gain more traction as we near the 2023 budget. It will have to be seen, however, how the centre chooses to address the demand, if at all.
India's robust GST collections clearly point towards one thing, that its economy is growing at a good pace. Global companies too are increasingly seeing India as an attractive investment destination. A series of developments in China over the last 3 decades, including the gradual increase in labor costs, have prompted companies to look for alternative destinations. And the recent lockdowns and protests are giving fresh impetus to China Plus One policy. So will India be able to reap the benefits of its demographic dividend? And will it score over its Southeast Asian rivals? Surajit Dasgupta presents a picture.
While some may fret about the fall of the rupee against the mighty US dollar, economists are likely to disagree. A depreciating currency has its virtues too. The sharp fall in the value of the rupee over the years made the Indian workforce more attractive than China's. One of the lowest labour costs and a large surplus workforce, which will continue to grow till 2031, are the key competitive edges that India is leveraging to challenge its rivals in Southeast Asia in the race for a China Plus One strategy. But the race is tight. Thailand, Indonesia, Malaysia, the Philippines and Vietnam are trying their best to woo global companies that manufacture in China and are now exploring alternatives. On the labour front, India, it seems, has the clear edge. It has the lowest manufacturing wage cost in the region. At $0.8 an hour, it is 20% lower than Indonesia, nearly half of Vietnam and the Philippines, around a third of Thailand and a sixth of Malaysia. The data was analysed by Morgan Stanley. On the other hand, China's manufacturing labour costs have risen to $7.1 per hour, far higher than India and other Southeast Asian countries and much closer to Taiwan's $11.7 per hour. India can also provide a constant supply of labour to power manufacturing growth for years to come, unlike other countries in Southeast Asia, where there is a growing shortage of labour in export-oriented industries. India will add 97 million or 22% to the world's working age population between 2021 and 2031, according to UN Population Database estimates. China, meanwhile, will see its share go down by 7%. Indonesia, which has the third biggest labour force, will add only 4%. Latin America will add 7%, and the rest of Asia, excluding Japan, will add just 1% to the working population during the same period. India's working population of people aged over 15 currently stands at 471 million, second only to China. But what about the quality of our workforce? Clearly, this is the area that the country has to work on. Around 11% of the labour force have only intermediate education and some skills in India, far lower than in Indonesia at 31.2%, Vietnam at 24.3%, or Thailand at 23.2%. And the actual numbers are far higher because of the far bigger labour force available. But over the years, productivity has shown a substantial improvement. According to Morgan Stanley estimates, based on ILO data, the annual growth rate of output per worker in India was up by 4.8% between 2011 and 2019, better than Malaysia at 2.6%, Indonesia at 3.7%, and the Philippines at 3.3%. But it is lower than Vietnam at 5.7% and China at 6.5%. A global electronics company executive familiar with India and Vietnam told Business Standard that lack of enough availability of trained labor could be an issue for future growth in Vietnam unless workers are brought from other adjoining countries. And how can India grab this opportunity? The executive points out that India needs to do a few things to take advantage of the edge in labor cost and availability by easing labor laws and removing restrictions on simple things such as having rooms for them to stay on the factory premises. Yes, India does have an advantage in the current situation, but this labor advantage alone may not be enough to encourage companies to shift production capacity from China to India. Other issues such as ease of doing business, incentive structures, cost of power, duties on inputs, and free trade agreements also matter, and here Vietnam may have an advantage over India.
Meanwhile, foreign portfolio investors returned to Dalal Street after over 2 months, pumping in over 31,000 crore rupees into domestic stocks till November 25th. Domestic investors have also moved past inflation and rate hike worries, which is enabling Sensex and Nifty to keep scaling fresh highs. This bullish momentum has spread to the broader markets too. But will it sustain? We find out in our next report.
The optimism in the frontline indices, which scaled their respective all-time highs on Monday, is beginning to extend to the broader market as well. Of the Nifty 500 index, data shows around 312 stocks are now trading above their respective 200-day moving average. Stocks holding above their respective 200 DMA tend to perform better in a trending market. Among the lot, Adani Enterprises, Axis Bank, Canara Bank, Coal India, Hero MotoCorp, M&M, Reliance Industries, and PVR are few stocks that are significantly above this key level. The recent bullishness, according to analysts, is being driven by hopes that the worst of inflation and central bank action is now behind us. Broader markets, especially the small cap segment, are also expected to catch up to their larger peers.
Small cap index has now started doing well. Actually, yesterday only the small cap index has given breakout from the range, and it was underperforming since last 2 months from 14 September. So now I think it may outperform. The chart suggests that they are going to outperform. It has crossed the 15 September. I mean, it is highest since 15 September. And if you know, volumes were dried up in mid-cap small cap during last couple of months. So now volumes have also started rising from yesterday. Advanced decline ratio has started moving up. So it seems that Nifty small cap index will eventually cross this September high, which was 10181, and that's going to be crossed, and it may go further higher from that level. 10,400 should be the target. One should look out for this Nifty small cap.
From July this year, the Nifty 500 index has performed in line with the Nifty 50, rallying nearly 17.5% during this period. Among individual stocks, Mazgaon Dock Shipbuilders, Rail Vikas Nigam, Karur Vyasa Bank, Union Bank of India, and Cochin Shipyard have rallied between 100 to 245% so far from July, while CIT, Punjab National Bank, IDFC First Bank, Bank of India, BHEL, and KRBL are some of the other prominent gainers that have surged 80 to 95%. That said, technical charts suggest the Nifty 500 index could scale new highs from current levels, with select stocks from the index looking to gain as much as 20%.
Over half of the stocks in Nifty 500 index are trading over 200 days moving average. In total, 312 stocks trade with a positive momentum and are likely to scale further highs. Overall, there is a broad-based bullish momentum, and Nifty 500 index can really scale further highs from here. Stocks like HDFC, BPCL, L&T, NLC India, and Raymond can see an upside of another 15 to 20%. Broadly to say, there is a positive bias overall in the Nifty 500 index, and we can see higher highs in major stocks that are in this index.
Equity markets will track global peers for a decisive move today. Investors will also track Eurozone CPI data later in the day.
Last week, billionaire Gautam Adani said that his flagship company will raise capital worth 20,000 crore rupees via FPO. FPO, or follow-on public offer, is one of the many means through which companies finance their expansion plans or pay debt. In today's Decoded, we explain what is a FPO and if investors should subscribe to it.
World's third richest man, Gautam Adani, is looking to raise funds. Last Friday, his group's flagship company, Adani Enterprises, said it will raise fresh equity worth 20,000 crore rupees by March 2023. The proposed fundraise, which is a follow-on public offer or FPO, comes at a time when the group is aggressively expanding into sectors such as cement and healthcare. It will be India's fourth biggest capital raising program and the biggest via FPO. And it will likely address concerns about the group's elevated debt levels and large promoter shareholding. But what is a FPO? Simply put, FPO is the issuance of additional shares by a company whose shares are already being traded on stock exchanges. A FPO is different from an IPO or an initial public offer, where a company floats its shares for the first time on a stock exchange. In comparison, already listed companies usually announce FPOs to raise equity or reduce debt. Typically, the issue price for an FPO is lower than the prevailing market price. It is done in a bid to get more subscribers to the issue. There are three types of FPOs: dilutive, non-dilutive, and at the money. A dilutive FPO is the one where new shares are issued, which leads to an increase in the company's outstanding shares. This dilutes its existing shareholding pattern. Adani Enterprises, for instance, is considering a dilutive FPO. However, since the proposed equity issuance is worth less than 5% of its current market capitalization of 4.45 trillion rupees, its equity base and earnings per share is expected to dilute by 5 to 6% at best. This, according to analysts, would not have any major negative impact on its share price. On the contrary, a non-dilutive FPO entails the issuance of shares that are already in existence. This means that directors or promoters will sell their privately held shares in the market. Thus, there is no increase in the number of shares for the company. Meanwhile, an at-the-market offering gives the issuing company the ability to raise capital as needed. That is, if the company is not satisfied with the available price of shares on a given day, it can refrain from offering shares. Most companies do not prefer raising funds via FPO now, as the process is cumbersome and involves higher distribution costs. Companies also have to organize numerous roadshows at different locations. While FPOs were popular in the early 2000s, there have not been many FPOs in India since 2015. Before Adani Enterprises, Patanjali Foods, earlier known as Ruchi Soya, had raised 4,300 crore rupees through follow-on public offer earlier this year. Prior to that, Yes Bank had raised 15,000 crore rupees via FPO in July 2020. So, are FPOs worth subscribing to? From a risk perspective, investing in an FPO is safer as investors already know the company, its management, and its financial statements. Moreover, since FPO prices are lower than market prices, investors have short-term arbitrage opportunities. That said, it's always important to do an in-depth analysis of the company before investing in it.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to reports, the proceeds of FPO being raised by Adani will be used to fund the group's foray into green and digital business. That's all for today. Catch the next episode of The Morning Show tomorrow. Bye-bye for now.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.